I'd like to welcome my guest, Ashok Bhatia from Neuberger Berman. Now, you don't have an earpiece, but what we just heard is breaking news is maybe the reports of exactly how much the U.S. is going to contest sharing or allowing companies to invest in certain strategic areas, maybe a fake news story. You know, it's very difficult. Even the news that we know to be true or coming from the president and administration regarding trade, it must be very tough trying to service investors at this point in time.
Yeah, you know, the trade issue is a challenge. And we've got this July 6th deadline for the $50 billion. And, you know, our sense is volatility is going to keep rising over the next week. We've got the Mexico election coming up in that period, too. And then we'll see if we get to a deal. But, you know, the introduction of the threats of the $200 billion tariffs, the European car maker tariffs, it's a risk that's been there, but it's just percolating a little bit more into the market. But, you know, we're reaching a deadline where, you know, we can punt on it, but at least, we think something's going to end up happening one way or the other.
It's so hard to get bearings. I mean, you know, I see companies here quoting Chinese news stories, which I don't know if there really are news stories in China that are worth quoting. Fixed income market seems to be snoozing, at least up till now, through most of this, which is really a big story in itself.
Yeah, I think there's just a couple important things on fixed income. One is we had the sell-off in rates in January, and since then we've been treading water. I mean, we haven't really gone anywhere. But at the second time, we have seen weakness in credit markets. You know, really with the exception of the lower rated parts of high yield, a lot of fixed income's been under modest pressure. But the third thing is, you know, on a day like this where stocks are down, you know, 1% and rates are only down 1 to 2 basis points, that's a theme that's been going on in fixed income, that government bonds and treasuries just aren't providing the diversification.
We used to call it the crash syndrome. After '87, we were all conditioned. Weak equities, buy a few treasuries. But it seems as though, and maybe this is a coincidence, after we had the big portfolio fallout where blended portfolios to maximize positions based on volatility, that strategy blew up. It's really never been the same.
Yeah, no, and that is one of the things we're talking to clients about, and I think it's going to end up being more and more realized in the markets, is that treasuries are, and government bonds in general, there's just more headwinds on them, and that portfolio diversification effect, we're seeing it, you know, this year with volatility, when equity volatility rises, the impact on bonds. It's going to be with us for a while, and to us, that's the biggest story that's in the fixed income markets right now, or one of the biggest.
And the short end, we were talking off camera, you believe most of the action in the short end is probably done, and it still represents a nice spot for investors to hang out?
Yeah, definitely. I mean, the front end has been under pressure for several years, a gradual hiking of the Fed. We're at rates right now, plus or minus, priced for a Fed at around 3%. We think that's just going to find value. You can build investment grade, balanced short duration portfolios, you know, mid-single digit yields, and that's going to attract capital. It may not be today's story, but it's an intermediate term story for the bond market.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.